Historically, when you have high inflation and the Fed is jacking up interest rates to quell inflation, that results in a downturn or a recession. That's a recent quote from Mark Zandi, chief economist at Moody's Analytics. Now, many times a recession takes everyone by surprise, but there's a very good chance the next one will not. Economists have been forecasting a recession for a year now. In fact, we had economic contraction for 2 quarters in a row in 2022, which is most often considered a recession. Whether it's deep or shallow or long or short, who knows? But the idea that the economy is going into a period of contraction, it's pretty much a consensus. We've seen this story before. When inflation picks up, the Fed responds by raising interest rates. The economy ultimately contracts under the weight of the higher interest rates. Zandi said, usually recessions sneak up on us. CEOs never talk about recessions. Now it seems CEOs are falling over themselves to say we're falling into a recession. Every person on TV says recession. Every economist says recession. It's not normally like this. The information in this video is for educational purposes. This is not specific financial planning, health insurance, or investment advice. In addition, everyone's tax situation is different. You should discuss your tax situation with a qualified tax advisor before implementing any planning strategy. Now, during COVID, the central bank helped stimulate the economy and lending by taking interest rates all the way down to zero, and boosted market liquidity by adding trillions of dollars in assets to its balance sheet. That helped fuel all the demand, supply chain shortages, the stock market rally, and the housing boom. It's now unwinding that balance sheet and has rapidly raised interest rates from 0% in March to 4.5% this month. The Fed now has a serious battle with inflation. Central bank officials forecast there are more interest rate hikes to come, another 0.5% early in this year, taking short-term rates up to 5%. Those high interest rates are already taking a toll on the housing market. Look around. With home sales down 35.4% from last year in November, the 10th month in a row of decline. That's wild. The 30-year mortgage rate is close to 7%. Consumer inflation is still at 7.1% annual rate in November. Earnings expectations for corporate America are unrealistically high, and that means the stock market may be more vulnerable than we think. We'll start to see some significant margin compression in corporate profits. That's already starting, and corporations are taking steps to cut their expenses. The first place we're going to see it is in reducing headcount. Layoffs in techland already started, and we are seeing more and more layoffs spread across the country. When we are less confident about our financial future or worried we may be laid off, we generally spend less and borrow less. So the economy contracts and inflation comes down. Now, how bad will it be? A recession is considered to be a prolonged economic downturn that broadly impacts the economy and typically lasts 2 quarters or more. The National Bureau of Economic Research, the official word on recessions, considers how deep the slowdown is, how widespread it is, and how long it lasts. The Federal Reserve's latest economic projections show the economy growing at a pace of 0.5% in 2023. Now, that's not much growth at all, but it's not forecasting a recession, which is interesting because it seems like the Fed wants a recession to bring inflation under control and reset the economy for more stable growth moving forward. In truth, it's unknowable how bad it could be. There are a lot of moving parts, and we aren't sure how related everything is. How bad really is the auto sector? What about home building, housing, and mortgage lending? Will consumers spend less and less because basic necessities are taking more and more of their paychecks? How does the crypto collapse and the evaporation of wealth that occurred there play into this? And are corporate earnings expectations too high? If they are, then the stock market may have further to fall. These are all questions that will take time to play out. Now, what is the Fed pivot? We've been hearing a lot about this. The Fed pivot is the point where the Fed may have to stop raising rates and actually lower them back down, reversing what they just spent over a year doing. How long the Federal Reserve will be able to hold interest rates at high levels is unknown, but now the rates have risen to the highest levels since 2007. The Fed can lower rates to provide support if a deep enough recession occurs. The Fed is not going to give up on the inflation fight until it believes it's winning. They were so wrong about inflation in 2022 that they would lose all credibility if they lower interest rates too soon without getting inflation under control. So for now, tighter financial conditions should be expected, tighter lending standards, higher interest rates, and lower demand. It'll be interesting to see how 2023 unfolds, but no matter what happens, if you have a well thought out investment strategy, you should stick to your strategy. Remember, investing returns over time come to those who are willing and able to weather the storm and the volatility that comes with investing in growth-oriented investments. And if you're looking for more information about whether now is a good time to be investing, make sure you check out this video next to learn why I think the time to buy is now, what strategies to pursue, and why if you don't take advantage, your future self will most likely be disappointed.